For the next, several minutes. I'm going to hang out here and I got a little bit of coffee. I'll probably go get more coffee. Actually, I should have gotten coffee before I went live, but I'm going to get more coffee. And while we let while the room loads with peeps, while people come and start hanging out with us, we'll see what's going on. At this point, the Dow down another 5.5%. Down about 1,200 points. So we'll talk about that here in just a moment. I think it's always good TV to have an empty chair, you know? So while we're hanging out, just a few things about the show. What is interesting is I was getting ready to go to Japan tomorrow to visit my daughter. And I'm very sad that I'm not able to visit my daughter. We were going to spend 2 weeks. It was going to start tomorrow. And we were leaving at about 11:30 in the morning tomorrow. And then going to spend the whole next day at Disney, a couple days in Tokyo, and then head south to Kyoto, Okayama, and then go to Hiroshima and head to where my daughter lives in a town called Kirishiki. So that was going to be a lot of fun. And because of that, we were getting way ahead of the game with our podcast. Usually, we try to be topical, and it's often our competitive advantage. So today I receive a review from somebody saying that Rome is burning and we must record these ahead of time. And the podcast is just okay because it's not up with current events. I will tell you a couple things. First of all, it is incredible to me that somebody wants more panic at a time when everybody else is panicking. Why you even want that is beyond me, because I don't know about you, but I'm kind of thirsting for a little normalcy. That's what I want. So I don't really want 24/7. How can I panic about current events when if I'm retiring 30 years from now, 20 years from now, 10 years from now, I shouldn't be panicking at all. So why even want that is beyond me. But second, how up to date 24/7 do you think your podcast can be? It just, there are times when, you know, and you got to have kind of a thick skin when you're a podcaster, because there are times when you get reviews and you try to take the stank out of it, right? Because people don't know what they don't know. They don't know what they don't know. So you try to get rid of it and say, okay, what can I do with this? Well, we can record more closely. Okay, I'm going to go on vacation once in a while. Could maybe have somebody else sit in for me. Maybe do that. Maybe that's what we do. I don't know. But I try to find something useful. And all I can think of right now is, what do you do with that? What do you do with that information? So let's give you some information that you can use for those of you that want some 24/7 update stuff. Hey, Kevin, what's happened, man? I'll give you some stuff, which is topical. First of all, when it comes to the long-term stuff, let's take a look at this. Back, you know, I want to do comparison between 2008, 2007. I'm very happy also to take a look at 2000 to 2002, because I was practicing and doing major media at both of those junctures. This is a different case than either of those. This is much more of a 9/11, where everything happening in the markets is much more based on news than anything else. And the bad news is we can't predict what's going to happen in the news tomorrow. We certainly will get some numbers over the next quarter that will give us something to chew on. But between now and the end of the quarter, we don't have any numbers. Any numbers that we have in the way government statistics work, which, by the way, if you completely believe government statistics, no matter what country you live in, you're crazy. But directionally, I think to some degree, you have to be able to look at government statistics and make some decisions. But I think that overall, and I just spilled my coffee all over the place, but I think that overall, this is a much, much different situation. In 2007, 2008, the debt to GDP ratio is about a 135%. Now, off the top of my head, it's closer to about 95%, meaning that there is a heck of a lot less debt right now per person than there was in 2007, 2008, when the wheels came off because of the fact that there were all of these loans out there that, frankly, people, after I spilled my coffee all over the place during my rant, I went to clean my keyboard, and apparently you can't do that because it ends the session. But the debt ratio is much better now. The economic news before this was much better now. So while it's okay to feel some fear around this economically, I'm not even going to talk to the virus itself because that's out of my lane. But while it's okay to think about it and to be fearful during this time, I think that if this ends up being a short-term deal and people go back to business as usual, then nothing changes. We still have an economy that then is slowing down, but not, it's still very robust. We still have very low unemployment, where we end up with an economy that is humming along. On the other side, if this goes for a long time, I think we have a whole different set of problems. Obviously, if the game fundamentally changes, if businesses do business differently, if people don't go out in public anymore as much, so the nature of restaurants, gathering places, live events, cruises, airlines, if that stuff all changes significantly, that can change the game, which is also why I think betting on airlines or betting on cruise ships is crazy now. I mean, I look at things like a conversation I had on Twitter yesterday with somebody saying, is this when you buy Delta Airlines? Is this when you get into Delta? And I thought, well, seeing that Time Magazine just had this piece about how airlines may be going bankrupt in May if there isn't any government assistance, I would say probably not. And this person's reply to me was that airlines are necessary and there's no way the government will let them go under. Remember, you don't have to go back that far, guys. 2007, 2008, Lehman Brothers went under. The day before Lehman Brothers went under, there was a guy who, an analyst who said that Lehman Brothers was too instrumental for the government to let it fail. One of the top analysts said that Lehman Brothers would not fail the day before it failed. And the government didn't step in. And then, of course, you had Bear Stearns, you had Lehman. Then, of course, being in Detroit, we have the auto manufacturers. There are people saying, well, these are the auto manufacturers, the backbone of the economy. Government won't let them fail. I would not bet on an airline. I would not bet on a cruise line. I don't know. If you're going to do anything now, I think I think raising your contributions wherever you're contributing money, whether it's just a regular brokerage account to a 401k to a Roth IRA, whatever, raising those contributions so you're dollar cost averaging more rapidly is a great idea. I think if you're like me and you have a fairly robust risk tolerance, I did have a piece of my my SEP IRA has been invested all along in Ginnie Mae's. And I switched my Ginnie Mae's this last week over, this was at M1 Finance, over to small cap value. My whole goal was to take the standard deviation and move it north as far as possible. Now, what's that going to mean? Over the short run, it probably means I'm going to lose my ass. However, looking at how far down this market is already and how undervalued a lot of pretty decent stocks are. Once again, I say undervalued. Kevin makes a great point, says this is different because people aren't leaving their houses. That's true. You know, we say undervalued, but valuations are going to change a lot here in the near future. The next quarter's earnings are going to be a rip. It's going to be absolutely crazy. So my friend Linda P. Jones, the host of the Be Wealthy and Smart podcast. Linda does a lot of technical analysis stuff. Linda had some fantastic charts. And it's funny, at times when you look at traders and charts, I totally believe, Linda, that charting can make you feel a lot calmer. So Linda showed some charts that showed just how undervalued this market is. And she believes that we will have a W. Now, I'm not in the business of crystal ball, and I never have been, but I do like her point of view that we might see an upsurge just based on all the information that she showed at some point here in the next few days. Might see a roar back, but then when we get quarterly earnings, we're going to see it go back down again, because quarterly earnings obviously are going to be horrible for anybody, for a lot of companies in America. People are pretty frozen. I would imagine there's not a lot of people doing a lot of buying right now. So that's interesting. Melissa, I also like what you're saying here. Development of the delivery industry is going to be interesting. There's autonomous vehicles being tested right now. Perfect time to do it. It is perfect time to do it. Not a lot of people on the road, right? And I know that Len, who does our Friday show, he's working on some technology for his company that is in that business, and the stuff he talks about is just fascinating. Just absolutely fascinating. But he said that rules and regulations have been tough. Well, maybe rules and regulations are going to change here over the near future. So that'll be great. Melissa also says upping the 401k contribution. Yeah, I like that. Yeah, it's funny when they said Delta Airlines, I thought, are you nuts by Ford? I don't think investing in a single company is a great idea. I think small cap value, I think whatever your risk tolerance is, going broad, and not betting on a single company, but betting on top companies in a general asset class could be a great idea here. So as long as you're not thinking about the short run, if you're thinking about the long run, I think it's fantastic. By the way, let's see if my keyboard's dried out. I still have coffee all over the place. We've had the most fun discussions in the Basement Facebook group. So if you're not part of our Basement Facebook group, you should come join us there. I was just talking to my friend Brittany from Haven Life about a lot of cool stuff that her team is talking about, not just around coronavirus, but just strategically. One of my favorite people to talk to, but she was talking about how our Basement Facebook group is one of the few places she goes because it's so damn funny. And I'm looking for the coworker one. I'm seeing this all over now, but I first saw this in the basement. I'm not seeing it. Where you refer to the people at your house and the animals at your house as your coworkers. And of course, the one time I'm scrolling and I'm not finding it anyway. All right. That's why can't you open the window today? That's what I'm wondering. All right. Anybody have anything they want to talk about, want to hang out and discuss? I can talk about board games all day long. So we have had board game night here in the basement. We played a game called Vinyl, which is everybody is, you're all in a record store and you're trying to put together the best collection of old albums. And it's this really fun, fairly, not very hard. It is a strategy game, but it's not that hard of a strategy game. It's really good. But it's also fun to have board game nights in the middle of the week. Just what else are you going to do? There's no sports on TV. Like it's crazy. Wes says, my wife and I just finally opened our Roth IRAs 2 weeks ago. Been waiting to invest the money into a Target Vanguard index. Should I stop waiting or keep watching? So let me see if I can bring up Linda's stuff, because, on our show, we talk not a lot about technical analysis. There's two types of analysis. There's technical analysis and there's fundamental analysis. And what I like fundamental analysis. Let's go over what these two things are, because I think that they're really important, and the difference between them and understanding the difference between them is really important. Fundamental analysis is important if you invest in individual stocks over a long time period. And that is, how well does the business operate? And if you invest like somebody like a Benjamin Graham, who Charlie Munger and Warren Buffett follow, or a Peter Lynch, as an example, some great books around the turn of the century. These guys usually are looking at fundamental analysis. Is this a good company? Does the company have great cash flow? Is their order stream picking up? Their sales picking up? Are they investing in the company? Do they keep low debt? Like, how does this company operate? By the way, what I really like about fundamental analysis when we talk about financial planning, I really like thinking about a family as if it's a company. So think about this. And if somebody did fundamental analysis on your family, where would they say that the weak points are? And then it makes it really easy to kind of get out of the trench and start looking more from a 30,000 foot view down on your family and going, okay, how do we make improvements? Where are we weak? If we were a public company, what would people do? But that's fundamental analysis. Technical analysis is voodoo. And the voodoo is that this is all based on traders. It's the stuff traders look at to see if a stock's going to go up or down in the near term. People use all kinds of strategies. There's the upside down teacup, where if a stock goes up a little bit and then down, you get this little movement, and then you'll get this big teacup up. So you wait for the little up before you buy with the big up. There's all kinds of different strategies around technical analysis. Usually the only reason it works is because people think it works. However, if there isn't news, technical analysis does work because so many people believe in it. And because it's a large number of people, it's not going to go away. But we don't talk a lot about technical analysis because, frankly, it isn't a great way to buy funds. Usually you're going to look long-term. So long-term, I'd say this: from a fundamental standpoint, Wes, what we're looking at here is going to pass. And when it does pass, I think we're going to go back to flying again. I think we're going to go back to shopping again. I think we're going to go back to eating at restaurants again. And if that's the case, then buying now versus buying a month from now, 2 months from now, 10 years from now, your money's not going to know the difference. Just go back and look at any chart that shows 2000 to 2002, even 2007, 2008, 1987. Like it makes a great case for who cares over the long run. But when we look at individual stocks, technical analysis can kind of show us where we are. So let's see if I can share my screen. And you're going to see that I've got, there we go, my entire screen. All right. And we're going to look at Linda P. Jones. You're going to notice I've got 7,000 icons open. Welcome to my world. And most of them, by the way, are files for the show. But if we take a look, this is October of last year through now. And by the way, this is my friend Linda P. Jones. If you want to look up Be Wealthy and Smart, Linda follows this a lot. So this green line here is this shows how oversold the market was. You'll see this is March 16th, which was 2 days ago. And the market's, has gone down further. So this is where the moving average is. This is where we are today. So the difference between those two, you can see, is much more massive than it's been. If we take a look at the orange arrow, the orange arrow is the moving average. So this is the 200-day moving average, and this is now. You can also say, I'm not even going to get into the green line, and I won't get into the purple line. But the difference between these two, notice the huge widening of these two numbers. I get really excited when I see the fact that those are so far apart. We'll stop sharing my screen. Oh, it's funny. I wasn't even sharing my screen. I thought I was. I barely know how to use this. All right, let's show that again. There we go. And let's solo on. Now you'll see my screen. There we go. So this is Linda P. Jones, Be Wealthy and Smart. Here's the orange line that I was talking about. This is the 200-day moving average. And what you'll notice is that stocks have been trading above this moving average line, which is this red line, right? So we got this red line. This is back in October. This is today. And so this is how trading has been. These are the prices of the shares. And by the way, these little candles here, as they call them, that's a single day. So remember, we had these first initial days. We thought these were big days. And by the way, if there's a difference between day one here and day two here, that's just the market opening a lot further down, but there's not a lot of range in the day. This is actually the range, this big red candle here. That's a day where there's a lot of range. And notice, by the way, in quite a few of these days where there is a big range, this chart down here shows the amount of volume. This is the number of people trading. So my first question is, why the hell is everybody trading when you don't know what's coming tomorrow? It's the dumbest time to trade, and yet you'll see trading levels are off the charts. This is the reason why Robinhood couldn't keep up. This is the reason why brokerages are reporting these absolutely record numbers for people trading. But it's silly. Why do you trade when you don't know what's coming tomorrow? Trading is the worst thing to do right now, and everybody, like a moth to the light, is trading away. So this red line, though, is the average. And look we crossed the average back at the beginning of March, but look at how far below the average is 2 days ago. Now we're way down here, right? We are so far below the last 200-day moving average. That is nuts. We're getting so far away from the average. And the further away that we get, the better the opportunity becomes. There's another couple lines down here at the bottom called the MACD, and the MACD, and that's going to take me forever to explain the MACD, but the further the black line goes below the red line, the more of an opportunity it looks like you have, and the more oversold the market looks. Look at, usually the MACD will get a little oversold. Notice this. So this is back in October. The black line went below the red line, and when that happened, you saw the market came up right after that. Happens all the time. And we saw it again right here. So this is back at the end of January. We got the black line below the red line, and we've got the things come up. That's the opportunity. Look at the opportunity today. Big opportunity. Now, what's the problem with that? And I'm going to stop sharing my screen here. The point here, though, is this. It's that we have so much news coming out that opportunity can get a lot bigger. I mean, we're in different territory. So, Wes, to answer your question in the longest way possible, I I I think there's a huge opportunity. I think 10 to 20 years from now, we're not going to know the difference. I would go ahead and invest it in a broad-based index based on your goals. If you're not sure what the goal is, hey, the some index like the Vanguard Total Stock Market Index that we make a lot of fun of a lot of the time is a fine place to go. Just go broad, invest a little bit in everything. You're going to see the general upsurge. Not what I do long term, but over the short run, I really like that. So, all right. Sorry about not being able to see it. Everybody's telling me, and I was so into my chart that I couldn't see you. You were watching me completely into my chart. Robert, I'm looking into bonds. Where do I start? Robert, I hope you're kidding, because it's a horrible time to buy bonds. A rotten time. When everybody is buying bonds, it's not a great time to buy bonds. You look at the run up in treasuries. The only thing that is good for, the only thing good about, so I'm going to talk about two different types of bonds. Type of bond number one is a treasury bond. Everybody's been flying to gold and flying to bonds, right? Let's talk about gold first before we talk about gold, just to get that off the table. Gold is 8 times more volatile than the stock market. You don't like the stock market volatility. Why the hell are you going into something that's 8 times more volatile? I don't know. Don't get it. Gold goes through these long periods that are unpredictable, where you have no idea where it's going to go. What I do like about gold, the only thing I like about gold, is that in a lot of markets, gold does not correlate at all to what's going on in the stock market. So a little piece of gold, if you want some, maybe 5% or less, is like adding a little Rotel to your chili, right? Gives a little spice, gives a little something different. I like that. I do not like generally gold, though, in a portfolio, and history bears out the fact that that's been just a rotten place to go. Why we keep seeing it, don't know, but we do. Treasuries are a whole different deal. So treasuries get sold at auction. And when treasuries get sold at auction, what that means is that people bid for them. But different than most auctions, people are bidding on the interest rate that they will take on those treasuries. So let's, just to be completely ridiculous, let's say that I bid 5%. You say, well, I'll take 4 3/4. Then I say, well, I'll take 4.5. Then you say, well, I'll take 4 1/4. Well, I'll take. So what they do is they bid down the interest rate that the government has to pay until somebody takes it. Right now, people are taking next to nothing. And at the same time, that also makes the price of existing bonds go through the roof. Because if I've got a bond that pays 2% and the treasury is now paying 1%, everybody wants my bond. So now people glam onto these bonds and the price goes up on the open market. So prices are high, yields are low, crappy place to be. The other type of bonds are corporate bonds. Now, what don't I like about corporate bonds? Well, I talked about earlier about companies going bankrupt. And if companies are going bankrupt right now, and I have loaned them money, I'm really not excited about loaning companies money right now. I mean, I might do it as a favor, but as an investment, there's no way, with all the uncertainty, I want to be loaning companies money at this point. And by the way, junk bonds, which I usually love, I love high yield bonds. High yield bonds are companies that already have a lot of debt. Imagine companies that don't have any cash, have a lot of debt, loaning the money right now. Nobody's shopping. Nobody's going out. Nobody's buying. So it's going to be very tough for those people. Avi, yes, this is how the basement looks. This, by the way, so we have this, and we do Money with Friends live on Facebook. You see this behind me all the time. And since we're all stuck at home, I'll tell you what this is. My mom gave this to me for my birthday. We'll call it my 39th birthday. And she had it framed, but you'll notice here over my shoulder, right there, it says Joey Sehy, Mrs. Berglund's 3rd grade. This is a true sign of genius, guys. This map behind me. It's funny because we used to have a Stacking Benjamins thing when we first moved here a year ago. We had a Stacking Benjamins thing, and Ben Franklin's head was right around me. It looked like I had this halo. And if there's anybody who's not a saint, it's me. But it also looked just ridiculous. So I threw this up behind me. We've had it up ever since, and it just is, it's a lot of fun. But you'll notice some sheer genius. First of all, North Carolina doesn't need the hump that they had. And by the way, West Virginia, if I ever run for public office, remember that I gave you some beachfront. So not only do you get the mountains, you get some beachfront. Maryland kind of hates me. There's Maryland, that little tiny thing there. Sorry, Maryland, but West Virginia apparently I love West Virginia in third grade. So somebody had to eat it. Delaware, you're welcome. You're huge. So that Maryland really took it on the chin. I don't know what I had against Maryland. All right, let's see what else we have here. Should I lower my monthly bond contribution up my stocks during this difficult time, or should I do nothing, Dodo? I'll tell you what, so the correct response here is to do nothing. If you've got a long-term goal and you're working to meet that goal, the big thing you should do is up the amount you're putting in, not change your allocation. Your allocation shouldn't change. However, that said, I'm an opportunist like a lot of people. I'm willing to bet that the economy is going to survive. And for that reason and that reason alone, I have upped what's called my standard deviation, meaning I went from some of the bonds in my portfolio, I took them and I put them instead into small cap value. What that did was like a nitro packet for my portfolio. So instead of having Ginnie Mae's, which are going to go like this, I went to small cap bonds, which are going to go like this. And I kept it diversified and did exactly kind of, Dodo, what you're saying, but even on a more stimulated basis. Dangerous? Absolutely. If small companies are more likely to die than large companies, but I believe in the economy. I think that I can't time the market. So I just did it Monday night. Monday night said, you know what, this goes lower. That's fine. But after seeing not just Linda's charts, but doing a fair amount of homework, said without trying to time the market, I'm going to up my standard deviation. And that was the one piece that I had. But that's not the correct answer. The correct answer, the appropriate answer is stick to your investment policy statement, look long-term, look to see if you can increase your contributions. The easy win, guys, is to increase your contributions. The one thing we're doing today, our gym closed yesterday. We haven't gone to our gym in a week and a half. Probably not going to go for the next 2 months, sadly, because I love going to the gym, but I'm going to cancel my gym membership for 2 months. During that 2 months, I'm going to put that money into my portfolio, right? So if you can do that, that would be great. Let's see what we got here. Brian, thanks, man. It is, it's fun to make the show. We've had we've got so much fun stuff coming up. The team will tell you. We actually I have on this SD card right here, a file that is some of the funniest stuff we've ever done. And I think that of all the financial podcasts, we're probably the only one that edits for funny. We will pause a show to make sure we have decent financial advice. I know we take a lot of pride in making sure that our advice is good, but we don't edit for good advice. We edit for funny, and we're always trying to make the show funnier. In fact, we did a 2-hour meeting yesterday about stories and about storytelling and a better storyline to make our interview stronger and to make the storyline of every show a little bit stronger. But the thing that's on this card that I can't tell you about is hilarious. Just, I can't wait for you to hear it. Cat, how many acres was my family's berry farm? So this is interesting. Interesting to me. It's interesting, that anybody wants to know about the berry farm, but so my grandparents in a little town called Vicksburg, Michigan, just south of Kalamazoo, had a 125-acre fruit farm. And while 125 acre farm is not a huge farm, if you're a fruit farmer, that's a decent acreage. And it was mostly blueberries and apples. And I ran track and cross country in high school, and then for the Citadel, the Military College of South Carolina. And when I'd run here locally, locally back in Kalamazoo, wherever I went, people would come up to me and ask, are you from the Blueberry family? And of course, yes. And I remember so many weekends where we'd be out picking blueberries, and it would be, one for the pail, two for my mouth, one for the pail, two for my mouth. And then I'd spend the afternoon rolling around the floor because I had such a stomach ache from just crap loads of blueberries. I was like that girl on Willy Wonka. I should have turned blue, but the blueberry farm was 125 acres. And I learned a lot there about, which I think are some good analogies about the right time to plant and the right time to harvest. And going back to that chart that I showed you a few minutes ago, there are times to harvest, and this clearly isn't one of them. This is a horrible time to harvest your crop. Do not harvest your crop now. Base that on your goals. And it also makes it easier to pick investments when you look at it that way. Because if I know if I've got a 15-year time frame until I need my investment, then instead of having to know all these investments, I just have to know the investments that have done well over 15 years and pick from those, right? So I know that sometimes this field can be overwhelming with all the different stuff, but if I just focus on my goal and find out what investments have historically done well over that time, makes the homework I have to do so much easier. And then I find I'm chasing so much less stuff, and I can tune out from so much of the media that doesn't make sense. My mouse doesn't want to work here, so I am slowly getting down to be Schlees thing. Joe, enjoyed your recent discussion of rebalancing portfolios in your annual asset allocation periodic table. How does a volatile market come into play with rebalancing? Should I more frequently? Studies show over the long term that rebalancing more than twice a year, and you can almost make a case for once a year, doesn't make any sense. However, if you are very, very aggressive, rebalancing whenever there's a downturn to take advantage and fill into those more aggressive asset classes can give you a little bit more punch. The issue is time versus money. You're going to be way okay if you don't do any of it. If you just stick to that once a year rebalance plan or twice a year rebalance plan, but you can add a little bit of spice by rebalancing. I think today's a great day to rebalance. I think it's a fantastic day to rebalance. And even if you rebalance 2 weeks ago, if you're at a place like M1 Finance where I am, and you want to rebalance again, man, go rebalance again. No downside. Unless the economy goes away, then what is your money worth anyway? Right. Then we all just start going to move in with Len Penzo in his bunker. So Tubi Schlee thinks we're handing out t-shirts. We are not, but that was a great question. Kyle, I'm 27, got a new job in January. Let me see if I can get my mouse to work. I'm gonna move this over here to see if I can. I don't know what's going on with the mouse. There it goes. All right. I'm 27, got a new job in January. Congratulations, Kyle. Rolled my Roth 401k to Vanguard, and it's luckily sitting in cash since February. Holy crap. When do I start buying funds again? Similar answer to Wes's question. The answer is yes. If you look at a long-term chart, the answer is now. And by the way, even if you had invested in February, this blip, you're 27 years old at 57, this blip is not going to matter in the long term. But nice thing is you get to kick back a couple of years. I mean, we're trading that right now, right at I think at like October 2017 levels. So, hey, you get a couple. I mean, it's like you're Michael J. Fox, and you get to get in the DeLorean and go back a couple of years with your investments because you did that. If you want to be safe, and it usually costs you money to do this, you can dollar cost average in, where maybe you pick 3 dates over whatever time frame you want and put it in a third. You will see, if you follow directors of companies and you're looking into company research about what insiders do. By the way, people hear insider trading and they think of people going to jail. Insider trading, you only go to jail if you don't follow the rules, but insiders trade all the time, and it has to be public. So if following insider trading, I really like to see what the people at the top of the company are doing. But if you see an insider who sells 1,000 shares in January, 1,000 shares in February, 1,000 shares in March, they're working with a financial planner, or they have just a financial plan. They've got a well-developed plan where they are just systematically getting out and diversifying their portfolio as they probably are getting new shares that you may or may not see in disclosures as well. So when I look at insider trading, if I see one big sale by itself, I'm going to do some homework to see what the hell's going on there. If I see somebody who's selling, I'm not at all worried about it. So you could do that. The reason I say don't do that, 70% of the time the stock market goes up. And after the big down we've got right now, even if you missed the bottom, which who can call the bottom, I still think you're getting, a much better spot. Man, at 27, think about this. Use a rule of 72. So there's this rule called the rule of 72. If you divide the interest rate you think you're going to get by 72, it tells you the number of years it's going to take for your money to double. So we take Kyle at 27. Let's say Kyle's got $10,000. If he thinks he can get 8%, fairly aggressive, but over long periods of time, very doable in stocks. You look at 8% divided into 72, 9 years. So every 9 years that $10,000 Kyle has is going to double. So that means Kyle's money is going to double at 36. It'll double again at 45. It'll double again at 54. And it'll double again at 63. So say he's going to retire at 62, not going to spend all his money then. That $10,000 is going to double 4 times. Well, that means that right now Kyle doesn't have $10,000 if he focuses on that long-term approach. That 10 turns into 20. Second double turns into 40, turns into 80. It's $160,000 that he's already saved for retirement, which is awesome. Now, bad news, Kyle, $160,000 then isn't what it is today, but you've kicked the pants off inflation, which is always a good thing. It's good stuff. Hey, by the way, I'm going to take just a quick second here. We're going to do these more often on Facebook. We're firing up the Facebook channel. I think OG and I have talked about that. He really wanted to be here today, but being a financial planner, this is obviously busy time for him. So because, the only financial planning I do now is hanging out here with you guys, which, by the way, I love not having that job anymore. Subscribe to the YouTube channel here while you're here, and you'll get updates. And if you can't make it live, you can go back and watch it later. I put in UP as part of the. Oh, I did. Pete is here. Pete. Nothing I like more fun than making fun of the VTSAX approach. And don't get me wrong. I agree with Mom. Let's not make perfect the enemy of good, but it's so easy to have a good asset allocation that I think it's silly to stop it at 90%. Why would we do that? Matt. Hey, Joe, do y'all plan on changing up the format of SB? More of a daily update like Choose FI is doing. Sorry if you've already discussed. Just joining. Nope. We have no plans to do that. So here's what we're doing. I was supposed to go to Japan now, which is actually kind of hilarious because as I was mentioning as I first went live, we got this hilarious review of somebody saying, it sounds like you guys record way ahead of time. And while Rome is burning, you're talking about the same stuff. Well, yeah. Because who wants to get people into more of a panic mode when they're already in panic mode? I certainly don't want to. I want to have a little bit of normalcy. So, yeah, I'm happy to do these lives. We're going to do more of these. There will be no more. There won't be more podcast episodes. The podcast episodes will only tangentially talk about this situation because financial planning is always long-term, and we're going to keep hammering that. We always hammer that. We're going to keep hammering that. We'll have headlines about stuff going on as much as possible. I'll be working on the stacker because I'm not going to Japan. I was supposed to leave tomorrow. So I won't be. So the next 2 weeks we had recorded a lot of stuff ahead of time. So there is no, I will tell you what we're doing that you may want to do too. Yesterday we had a 2-hour meeting about better storytelling, which is going to help our interviews. It's going to help the story. It's going to help the episodes. We're also rearranging how we make the show. So some of us are better writers than others. Some of us are better organizationally than others. So we're redoing the back room of the show so that shows come together better. Our goal is to use that extra time that we have right now to make the shows even better and more impactful long-term. That's my first goal. If I can do that, then I think that we all win, because I think this will pass. I love what Jonathan and Brad are doing. I think that's a great idea. You're not gonna see us do it though. All right, next. My friend Mike, indexes for canned goods and ammo. Mike just stockpiled, my friend. We call it the Lempenzo Index. He's got a bunch of that in the bunker. That's funny. Should I put my percentage of my raise in my Roth 401k? I got 4%. The answer is almost always yes. Now, here's the thing, guys. I don't know if you guys have seen Maslow's hierarchy of needs, but there's also a hierarchy of things that you should invest in. And the very first thing is always cleaning up your debt and getting an emergency fund, right? That's going to be the bottom of the pyramid. Clean up your debt, get your emergency fund in order. So Karen, if your emergency fund isn't funded, it's funny. I started financial planning late in 1993. And the advice I remember from my early days hasn't changed, which is 3 to 6 months of money in savings out of the market. And you can see it right now. If you've got a job that's very stable, even during these times, 3 months, you can see now why 3 months would be important, because this is kind of the weirdest, strangest, toughest time that maybe if you've got a solid job might impact that. But even then, having 3 months money in an opportunity fund where something comes up, some opportunity, you can just take it and you don't have to worry about where the markets are. That's fantastic. On the other side, if you have a job that's not at all secure, having the 6 months in a cash reserve. I mean, it's funny how many times people have fought me on that, but you look now, nobody's fighting about that at all. So do that first. If you've got your debt level where you want it, cash flow is good, your emergency fund's in place, then yes, I'm doing the same thing. I upped my contributions as much as I possibly could a few weeks ago. And I think that's great. John, what events did I do in track? I was a miler. I did not run an exceptionally fast mile, but I ran it a lot, which is why I got recruited to and had a scholarship to run in college. So my mile was 4:16, and I ran it 6 times in high school. 4:16, for those of you that know the mile, fast, but not scholarship fast. But the fact that I could run it over and over and over with my eyes closed was the reason why I got a very nice scholarship. That was actually a funny story that I'm just looking at the time. But so when I got recruited, I thought I was going to the University of Nevada at Reno. And I, on the national letter of intent, the national signing day, my letter never came for me to sign. And so my mom called the coach and she said, you've got a very disappointed guy here, so you should tell him. Hands me the phone. Coach tells me that they got a new athletic director and they were going to not stockpile anymore on track where they were already good. They were going to turn to football more. And if you know, University of Nevada is still very, very good football school. So, but I was the cost of that. They already had fine distance runners. I was just going to be another middle distance runner. So I didn't go there. But April 15th was the national signing day. And here I am I haven't applied anywhere else because I did the stupid thing and I put all my eggs in that basket thinking there was no way I wasn't going to Nevada. So my mom worked at a church rectory. There was a thing then, this is an old guy story, but it was a mimeograph machine. I wrote up a 2-page letter. I went to my guidance counselor. We looked up all the different schools that offer scholarships, and I had to pay for my own postage. I had a part-time job. I had a little bit of money. So my homeroom teacher actually let me, everybody in my school, I went to a small school, knew my plight, knew how I was a kid without a school, couldn't go to Michigan or Michigan State right in my backyard unless I got a scholarship. I was going to have to go somewhere and run, and it was going to have to be at the last minute. So my homeroom teacher let me turn our homeroom, which was 15 minutes a day, into a factory where one person would take the envelope. Second person would take the 2 pages. First page was the letter with my predicament. Second page was just my time. Put those together, folded them. Third person put the stamp on them. Fourth person, and we had all these rows of 4 people. Fourth person then would address. And so I went forward through Emory and backward through all the university of. So any school in the middle of the alphabet I wasn't going to go to. I was just going to go to these ones on either end, right? Because I ran out of cash. So it was surreal because about 4 days later, my phone started lighting up, and within a week, my mailbox was full of mail and letters and nice people. I remember the coach at UAB, University of Alabama, Birmingham, very, very nice, telling me how they really wanted me to come run. They didn't have any money, but I fit in with their team. It was just super. I got some great calls. But anyway, the third call of one night, I get this call talking about palmetto trees and warm weather and a beautiful city. And I was just, I'm 18. And I said to the coach, I'm like, I'm sorry, what school are we talking about? And the coach says, it's the Citadel, the Military College of South Carolina. At that time, it was the Men's Military College of South Carolina. And I said, oh, no, thank you. We sent that as a joke, which is true. My friend Pat said, hey, let's send out to these military schools a joke. There's nobody less military, Joe, than you. And I said, yeah, okay, let's send it. So we did. Anyway, we get the call, and I told the coach, I felt really bad. I said, Coach, I'm not going to go to a military college. It's not going to happen. He said, well, let me just send you the stuff. So then I get this letter within a week, and it's this beautiful brochure. And by the way, my mom hands me my mail. I take it to my bedroom. My bedroom is a pigsty, just crap thrown everywhere. And I was just a mess. And I open it up, and there's this incredible, immaculate Citadel uniform and the shako, the hat that they wear when you do full dress parades. And it said the Citadel, where manhood meets mastery. And I looked around my room and I thought, maybe I need some of this. Maybe this is good. And I have to tell you, it was a phenomenal experience, and I did need it. And the discipline I learned there, and I learned a lot there. So anyway, that was my Citadel experience. And then what was really funny, so I said that I ran a 4:16 6 times. And they thought I was a diamond in the rough. I never ran faster than that. I still didn't run fast. It turned out I was just rough. There was no diamond in that rough at all. So long story. Mindy told that story. I am so far behind. Let's know more about Doug. Yes. So Doug in real life. This is just between us. Doug is a good friend of mine, been a good friend of mine. Doug actually started off as the alpha listener to our show. I think every show needs, and Mindy's heard me rant about this before, but I think every show needs alpha listeners, needs somebody who's a little Gordon Ramsay, and not just every show, but I think it's good to have these people in your life if you can accept it. Somebody that you know loves you and is somebody who's on your team, but somebody who's just going to give you the honest truth. So when we started the show, OG and I, he listened to every episode, And he would call me and go, why the hell did you do that? Or why didn't you tie that in better? Why'd you have that guest on? What does that mean? And the show, because of Doug, got better in a hurry. And but he's so damn funny that and I really wanted a way. I've been listening to podcasts for a long time before we had a podcast, and I really wanted a way to. I can't stand, breaks for advertisements, and I wanted a way to make the break for the advertisement much more natural. So I decided we'd have a trivia question in the middle of the show so that we give people time to think about it. And it was much better than some of the things I still hear today where crap, they're in the middle of a sentence and all of a sudden I'm hearing a Casper ad. Like, I didn't want that. I wanted it to be much more of a natural thing. And then we also, on days we started putting fake ads in, which is, by the way, I can tell you this. I mentioned this thing earlier. This is a fake ad that we're developing, which is, I think is hilarious. Your results may vary, but anyway, so Doug, I started to have this role for Doug. It was a nice break to the show. And then when we really redesigned the show about 5 years ago and things got really better, we embraced the comedy of the show. We decided to start studying comedy much more, study serious writing of shows much more and how good shows are made. We quit blogging, really became focused. And I realized we also needed more of a Tonight Show feel because of the fact that the show has so many segments. I needed somebody to explain at the beginning of the show that there were going to be segments. So so Doug's real role at the beginning of the show is to tell you that there's going to be a lot of segments because new people to the show need to know that ahead of time, that what it says in the title is not going to be the only thing that we talk about because it's not. And because the show is a little bit ADD, which we like, light, fun, fast, but hopefully making points about 4 or 5 different financial topics every episode. So Doug's been a friend of mine for a long time. We've evolved Doug over time. He's less creepy than he used to be. He's also more at a wall 100 miles an hour. He's getting a little smarter. I like Doug smarter. I want him to be an empathetic character more instead of just a dumbass. So we're always working on that character. In fact, we had in our meeting yesterday where we're sharpening the saw, we talked a lot about not just Doug, but about the characters in the neighborhood here and how we deepen that, not just for fun and for the show, but also for, expanding the universe a little bit, which we have some ideas around that. And to that point, by the way, Doug's show is going to come back. Doug's podcast is still going to come back. Yeah. This is what Mindy says here. Everybody thought that I was doing Doug's voice, which is funny. I don't even think our voices sound alike. And whenever I hear that, I think it's hilarious. So Matthew, how are you, man? Book recommendations, just for fun. I decided this year is the year that I take book recommendations from people that I follow in real life. I follow Bill Gates in real life, and Bill Gates had a fiction book. I don't read much fiction, but Bill Gates had a piece of fiction that he loved that his daughter had recommended. Then he read, and he was laughing so much, and he was sharing it with his spouse so much that with Melinda that it made his book list. And it's called The Rosie Project. And The Rosie Project not just was one of the best books I've read recently, it's one of the best books I've read. It is so damn funny. It is, it's so, I don't know. There's so much I could talk about The Rosie Project, about how well written it is, about what a story it is about a guy that, so this guy is a genetics professor in Australia. He's most definitely on the spectrum. But it seems like he really doesn't know it, but it's written from his voice, and the way he evaluates people and evaluates things is incredibly hilarious. And he says things that he doesn't think are funny, but then everybody responds to them funny, but he's so used to the way people respond to him that it kind of goes over his head. And to be able to write that is just amazing. But, being a guy who's incredibly analytical and knows that he has trouble finding dates, he does what any logical person would do. He creates a list of what the perfect woman will have. Perfect woman for him will have the perfect mate. And he goes out to find, he calls it the wife project. And he goes out to find the perfect mate. And it's hysterical. Second, building, refreshing my understanding of financial reports for companies. The early books that the Motley Fool did, the early books from Beat the Street by Peter Lynch. Beat the Street by Peter Lynch. Very old book, still fun to read. Talks about, Peter Lynch said something a long time ago that people still talk about, which is buy what you know. And I thought at the time, because I'd read his book, that people were misquoting, and people still misquote that. They go buy Nike shoes just because they use Nike shoes. He says that's the top of your funnel. Then you have to do some analysis, mostly fundamental analysis, but maybe even a little technical analysis, like we looked at a little earlier as well. Kat, that would be hilarious. That'd be absolutely hilarious. We do have a little something in store for that episode, and we just recorded it, and I can't wait for you to hear it. And I think I'll leave it there. Barb. Hey, Barb. Barb says, I'm 66. Should I move my SEP IRA into Roth? I'm actually working real estate, but that may voluntarily change soon. Here's the deal. We're gonna talk about this on Monday's show. We're gonna record Monday's show tomorrow. If you are doing a conversion, right, where you're converting stuff into Roth, you just got a huge discount, because when you take money that's pre-tax and you convert it, you've got to pay the tax in the year that is due, and it can't come from that. You got to have money in a reserve to do that. So you got to kind of calculate what the tax would be. Well, think about this. If you invested in stocks, your money went from here to here, and that's the value it's going to get taxed on. So there really is, what's the thing Mom says? If life gives you lemons, make lemonade. The lemonade in this situation is doing exactly what you're talking about, Barb. Great idea. Highly recommend it. Can't think of a reason not to do that, unless I would just say, I guess, that if you're going to use the money over the short term, meaning next 6, 7, 8 years, you're going to end up paying a tax now that you're going to pay just in a few years. So the time for that to climb back, I don't know that it makes a lot of sense. But if you've already done that math and you know that you're not going to spend it over the short term, great time to do it. Jeff says, I'm 30 years old. Would it be smart to roll my traditional to a Roth right now? Jeff, for you, absolutely. See what I just said for Barb. Fantastic idea. Barb, the interesting thing for you, Barb says she's putting money in a SEP, but maybe needs to add a Roth. I don't know. What I like about the Roth is it's flexible money. So here's the reason I don't know. At 66, it's a different cost benefit than it is for a 30-year-old. If you were 30 right now, I'd say, hell yeah, do that, because your money has time to grow to make up for the tax that you paid over the short run. The problem with the Roth is you're going to pay tax now. But here's the deal. If you don't have any flexible money that's just invested, filling up your Roth where you can take your contribution and take it out right away makes just absolutely a ton of sense to me. And hold on just a moment. I just got a message I have to reply to. This is thrilling, isn't it? I was supposed to go into an internal meeting 5 minutes ago. but it's something that we can delay. I was very happy to meet Chris in New York. Chris, hope you're doing well. Chris is, this has got to be a time, Chris, when you're happy that you're not a driver. Chris works for one of the companies that is making deliveries, and talk about something that's in high demand right now. That's crazy. Are you buying something fun now? Is it okay if Doug can ask you from Mika's voice? I am not buying anything. The most fun I did was I just changed over my Ginnie Mae bonds over to small cap value, just raising the standard deviation on my portfolio. Yeah, that's not good. I just the fact that, Barb, you even saying that about Italy, I'm just thinking about missing Japan. 24 hours from now, I was supposed to be on a plane to go visit my daughter. It's funny. I think, in just reading the short-term quotes, Amika, that I don't know that he is. I mean, I don't know that he, just looking at him during the 2007, 2008 crisis, when he stepped up and did a lot of buying, he was one of the prime movers that, when nothing else was working, I remember he was a guy that everybody kind of emulated when he started buying, saying, nope, I believe in the economy. So if he does buy, I think it's going to be more, it'll be measured. He'll buy the things. I think that if you're buying individual stocks, you should be buying less opportunistic and things that I like about a down market if I'm a buyer, which is I like the fact that down markets are indiscriminate. And let's be clear here. I don't want to take advantage of the fact that there's a pandemic. I don't want to take advantage of that at all. That's horrible. The dude selling sanitizer, marking it up a ton and trying to sell that crap, that's baloney. That's horrible. What I do want to take advantage of, though, and I'll do it all day long, unapologetically, if you're dumb enough to be selling your stuff now, I'm buying it. I definitely want to be a buyer, because there's no reason for you to be selling your stuff. I mean, unless you got a short-term goal. And then my question is, why do you have money that should be short-term in a long-term place like the stock market? If you've got a need for money in the next 12, 24, 36 months, you shouldn't be in stocks. It just doesn't make any sense to me. So yeah, I'm buying then. Lance is here with us. Hey, Lance. Diversky says, I've got about 20% more of an emergency fund than what I plan. Should I take that and invest it in VTSAX, or just sit on it in cash just in case? I'd invest in it based on your long-term goals. It depends, though, Diversky, on your goals, and not just on your goals, but also it depends on your job. I think right now I would look at your industry from a cynical point of view and say, is there any chance at all, if this becomes extended, that this affects my company and then affects my job? If there's any time to hang on to cash, it's if you're in an industry that might be affected. Like if you told me right now that you were a restaurant manager, I would say, sit on that emergency fund. But if you work for a podcast company out of your mom's basement, everybody's at home, could be listening to podcasts, go invest it. Yes. And I like investing. I like looking at what's called the efficient frontier versus VTSAX. With VTSAX, you're 80% there already. I don't know why you wouldn't go to just do 20 minutes of homework and invest it based on your goals. Better stuff. Zach, my mile time was the treasury bond at collegiate track and field. Yes. Nice job. Len and I talked about this yesterday, Matthew. He actually is in the market. He actually has been in the market with some of his money. And he actually, this is a sad thing, is, the worst time to retire, there's this thing of sequence of returns risk, which is if returns fall in a bad way. Look, read anything by Wade Pfau, Michael Kitzes, and you'll see that a lot of stuff about sequencer returns. Len has delayed his retirement, which was supposed to be this coming month of April, to at least July, because the sequencer returns look so bad, and he has enough money in the market that he doesn't want to do that. So, yeah, he finally got his up. Susan's here with us. Susan, I've been talking about your post in the basement all day, where we refer to our family members and pets as coworkers, and we write about them. My coworker is making me type one-handed, or my coworker is, doing whatever. We were cracking up about that yesterday. That'll probably make the show too. Got accepted to the Citadel's MBA program. I was in Charleston when you were in Charleston. I was there from 86 to 88. I got hurt in 88. And I had gotten the big benefits I wanted out of the military stuff. So, after 2 years at the Citadel, I transferred to Michigan State and finished up at Michigan State. In hindsight, I shouldn't have done that, by the way. I knew at the time that I could keep my scholarship. I felt guilty that I wasn't helping the team. And I knew that I wasn't going to run for at least a year because of an injury that I had. And so I decided to give it back, and I should have not done that. The little bit of debt I had that was student loans, I wouldn't have had those student loans, had I stayed. Old Climber, OG would have showed up. Doug wasn't invited to this one, but Doug, OG hopefully will show up on one. We'd like to do one either again late this week or early next week, and hopefully we'll get OG here. So we've got all kinds of Citadel stories. Ivan is here. I also met Ivan in New York. Hope you're doing well, Ivan, and safe. You guys in New York are kind of as you go into New York City, there's a sign, I think, not New York City, but New York State, that says the home of coronavirus. Like you're kind of where the epicenter in the U.S. Wanted to say thank you after 3 years of listening for the same things. Yes. Do nothing. I'm so proud of the people in our basement Facebook group. The level of excitement and irrationality I see in our group versus in some other places online that just kill my soul. I've been very happy. What do I think about borrowing from myself, my emergency fund, to finish maxing out a Roth IRA for the year? Here's the thing. And this is the same concept, money resolution. It comes back to that same idea of your job and where your income comes from. If you have a solid income, you don't think it's going to change, then by all means, I would do that. But if you have any chance at all that your job may go bye-bye, I would not go near that. Annie mentioned this a couple times before. I took some Ginnie Maes and I added them to small cap value. That is it that I've done so far. I've thought about some individual stocks, but for those of you that join later, I'm not going near airlines. I'm not going near cruise ships. I had a discussion on Twitter with somebody about buying into Delta Airlines. I'm from Detroit. Back in 2007, people said the auto manufacturers wouldn't go through bankruptcy. They also said that we'd need Lehman Brothers. The day before Lehman Brothers went under, one of the biggest analysts following Lehman Brothers said they can't go under because the government relies on them. And then they went under. The government won't let them go under, and they let them go under. Same thing with General Motors, with Delphi here locally. If you remember, Chrysler took the protection as well. It was ugly. Rena's got a great question. Some people think, Rena, that the Fed dropping interest rates is going to directly affect mortgages. The issue is that treasuries really are where it's at, but treasuries largely have been bid up too. So here's what I would do. I would contact your lender and see if you can do something first called a rate and term mortgage. They might not call it that, but here's what I mean by rate and term. I want to drop the rate, but I want to keep the term the same. So can I just do that? Or Like I have a friend who's 18 years to go on their mortgage. Can I maybe do a 15-year instead? By the way, I don't get that much into the term as much as some people do. You know, we just had an episode where OG said that he likes having that longer or that shorter term. I'm the opposite. And this is a little bit of know yourself. I would rather have the longest term possible and I pay extra. So that things go bad like they are now, I can then pay less if my industry gets affected or my income stream gets affected. So I want my debt payoff strategy to be different than what the term is of whatever loan that I've taken out. Think about yourself as a CFO of a company. A CFO is never going to pay back what the loan dictates unless it's the best thing for the company. They will get the best term as possible from a lender, and then they will create their own strategy to pay it back. Don't think that because you have a 15-year, you have to pay it back in 15. But if you're the type of person that likes having those guardrails and you're 18 years, 17 years away, and you can use a lower interest rate to get to a 15-year, this could be a big opportunity. The immediate opportunity is here. Car loans, refinance car loans. Usually you'll find a best rate through a credit union. Second place is credit cards. If you've got credit card debt, consolidation loans, also based on that Fed rate drop. So I would look at those two areas initially. And then to the extent that treasuries have also been bid up, maybe your mortgage as well. Arthur, would it be better to fund an HSA for investing using weekly deductions from my paycheck or fund the entire year's contribution now? Back to that same thing we talked about, Arthur, depends on your field. If you can afford to fund it now, do it, with the caveat that this is all based on your industry. We don't know where this is going. There's new news every day. This could be an extended thing. We don't know. If it is extended, how likely is it you're going to regret that, need that cash later? Do not go make long-term investments with short-term thinking. So I would keep your cash reserve funded, your emergency fund funded. All right. Mindy. That's very nice, Mindy. Thank you very much. And I think, guys, I'm looking, that is the end of our stream, which is good because we ran about 20 minutes over. Thanks to everybody for hanging out with us. OG just showed up in the comments, but we're going to try to get him on the next one. Hopefully we can do another one of these late this week. Laura, I like your thinking there. Stuff that fits your portfolio. I think that if you look at what's called the efficient frontier, go do a Google search on the efficient frontier, or better yet, here's something that actually Doug and I were talking about a little earlier. He always makes fun of me for using Bing. You know, Bing gives you points to use it. And now I use Bing by the way, I know my son works for Microsoft. I don't get paid anything by them. But even before my kid worked for Microsoft, I like this. What I really liked about Bing was I super like the fact that Bing was every time I use it, I get these points, and then I can use the points for Amazon purchases. We use it for, there's a bunch of different stores that I can use it for. It's just free money. And if I'm going to search anyway, to my job, I search all the time. I use that. But anyway, do a Bing search and look at the efficient frontier, and you'll see what types of investments are best for your time frame. So good stuff, guys. All right, everybody. That's it. Hopefully talk to you soon. Today's episode is up. Angela Poli, great time to think about health and wellness, especially if you're working from home. Got to get up and walk around and eat right. More energy. Chase more energy, not more time. All right. Thanks for hanging out with me. Talk to you soon.